Hello guys, welcome to my YouTube channel. Today's video is going to be about Forex, the basics of Forex for beginners. So if you've ever heard of Forex before or you've never heard of Forex before, I'm just here to show you the basic knowledge of Forex so you have an idea of Forex before you start trading Forex. Now, what is Forex? Forex simply stands for foreign exchange. The FOR stands for foreign and the EX stands for exchange. This is a global market that allows one to trade two currencies against each other. Now, what this simply means is in Forex, you don't trade just one country's currency. No, you trade two currencies at a time, put one against the other while expecting the other to rise or fall in value. So you have the base currencies and the quote currency. So we're going to see that as we move forward. Okay. Now, for example, in Forex, if you've ever left your country before to go to another country, you definitely need to convert your country's currency into the other country's currency. So, for example, if you're leaving from Japan to Canada, you need to convert the Japanese yen into Canadian dollars. So that is simply foreign exchange. So the only thing in Forex is you need to know when to buy and when to sell. It's always good to buy when it's low, when the currency is at a lower price, and then you sell when the currency is at a higher price. That way, the dividend is what makes you profit. Forex is the largest exchange market in the world. Like over 6.6 trillion US dollars are traded every single day on Forex. So if you put together the New York Stock Exchange market, the London Stock Exchange market, the Tokyo Stock Exchange market, all of them will not sum up to the value of Forex. So this little diagram just shows you like this is Forex, the huge monster. So, given that its liquidity is very high, one thing too is it fluctuates a lot. So, Forex is mostly done traded based on speculations because factors around the world affects the movement of the market. Events around the world affects the movement of the market, and then the major international banks, the big banks, actually do affect the movement of the markets. So you should be able to put all these factors together, be able to read your charts, understand the movement of the candlesticks, and then be able to speculate properly to be able to make money with Forex. Okay, now, next question is what is traded in Forex? The simple answer is money. Okay, because you're not buying anything physical. Forex trading is simply you putting one currency against another country's currency and then expecting one currency to either rise in value or fall in Sorry, I cannot read everything, but you can either pause the video and go through the notes so you do understand, but I'm just here to give you a brief summary of everything you'll be seeing. So this simply means you're buying a share in the Japanese economy. That is, you are taking the currency, the Japanese currency, and exchanging it maybe for the US dollars. So you take your US dollars and then you buy the Japanese currency. So that is what is traded. It's just money, currencies. Currencies equals the money. It's the money kind of thing. So Forex, we have different types of currency pairs. So we have major currencies like Canadian dollars, British pounds, European euros, Japanese yen, USD. These are major currencies. USD, Swiss francs, Australian dollars, New Zealand dollars. Okay, so they are called major currencies because they are the most heavily traded currencies and represent some of the world's largest economies. So in Forex, there are three categories of currency pairs. we have the majors, the crosses, and the exotic pairs. Okay, so the major pairs currencies, they always include the US dollar. Like the US dollar is one of the currencies most traded on Forex. And then cross currency pairs do not include the US dollars. And then exotic currency pairs consist of one major currency and one currency from an emerging market, so emerging countries. This is a typical example of the major currency pairs. It's like Euro USD, USD JPY, JPY is Japanese yen, uh, GBP is British pounds, USD. So in Forex, you mostly see currencies written like this in short forms. So you need to like understand when you see them. So this is just it. And you can see all of these currency pairs include the US dollars. So this is a major, these are major currency pairs. Now, here are examples of cross currency pairs. So you see, none of these currency pairs include the USD, the US dollars. Now, these are examples of exotic currency pairs. Exotic currency pairs are simply made up of currency from a major economy and the currency from an emerging economy. So, for example, here we have the United States versus the Brazilian real. Is it the Lea? I don't even know what their currency is. Okay, this one is USD against Hong Kong and USD against Saudi Arabia. So these are just examples. There are so many different types of pairs. You just need to know their categories, but this is not everything in Forex. Okay, all of these examples I've shown you, it's just a few. There are so many, like many of them. But I, for one, personally, I mostly trade just major currency pairs. Okay, and I'm going to tell you the reason why. It's very Okay, now how does Forex trading work? Okay, in the Forex market, you buy or sell currencies. You know, I can't read everything for you, but if you really want to understand more, please pause the video and go through everything. Okay, so Forex, you just need to have a prepared psychology to either lose money or make money. The mechanics is similar to that of the stock exchange market. So it's completely based on speculations. And then in Forex, we have what we call the bid price, the ask price, we have the spread, we also have what we call pipsology. The pipsology is it's referred to as pips in forex trading. Pips is what you calculate to be able to know how much you have made from a trade. Okay, so now if we move forward, you can see here is an example more specifically that the currency you bought will increase in value compared to the one sold. So this simply means, like, I just try to summarize everything so you can understand. For example, if these are two currency pairs, one currency pair, this is a pair, so it's not, it's one. This girl, concentrate. So this is euro and this is the USD. So now you purchase 10 euros at the euro USD exchange rate of this. This simply means 1 euro. 1 euro is equivalent to 1.18 USD. So for 1 euro to be equivalent to 1.1800, then 10,000 euros will be equivalent to this amount. So you're putting the euro against the USD. So now this is the base currency. The euro is the base currency, and the USD is the quote currency. So you're using, it's the value of the USD that you're going to use to compare. It's either the USD rises in value or falls in value against the euros. So now continuing with this example, now for example, you purchase today, right? Now 2 weeks later, you exchange your 10,000 euros back into USD dollar, and the exchange rate now is 1.2500. That means the USD has risen. Okay, it has increased in value. Your speculation was right. Now, how much did you earn? How much did you make as profit? You just made 700 US dollars. Okay, that is this minus this, giving you 700 US dollars. Okay, in Pipsology, you just have to calculate 1, 2, and 3. This alone, the number of pips that we have here. Okay, that's my calculator. Anyways, let's do that later. I will show you as we move forward. I'll show you. But this is what we use. This figure, the base figure, is what we use to calculate how much we've made as profit. So this is the difference between the reason price and the actual price you purchased. So this difference is 700. So that is your money. You have made 700 US dollars. But let's look at it the other way. If this had fallen, the value of the USD, if it fell to maybe about 8,000 or 9,000, then you lose money. Okay, you lose money. So this is all based on speculation. While you're waiting for the value of a country's currency to rise, it can fall. So you can never be sure in the forex market. You just need to be able to read your graphs correctly, understand the movement of the candlesticks. Candlesticks are very, very important when it comes to forex trading. You cannot trade without your candlesticks. Then you will die. Like you will not make it. Okay, let's move forward. An exchange rate is simply the ratio of one currency valued against another currency. That's what I've been saying since. You take one currency, you put another one, and you're waiting and praying. Which one is going to rise? This one, USD, please add, so that when I change this, my euros, I'm going to get more money. That is just what you do. So, most importantly, how to read the currency pairs. Okay, so like I said before, we have the base and quote currency. Whenever you have an open position in forex trading, open position means like just entering the market or maybe putting in a buy or sell order. That is you opening position in the market. So you are exchanging one currency for another. Currencies are quoted in relation to other currencies. Here is an example of a foreign exchange rate for the British pound versus the US dollars. Now, here you can see that the British pound is quoted against the US dollars. So automatically the base currency is the first currency in the pair. And the second currency is always the quote currency. That's the currency. Like for example, here, this currency pair simply means that one British pound is equivalent to 1.2122228 US dollars. So, in order for you to trade successfully, you need to be able to determine when to go long or go short. So, when trading, we have the long and short positions. Okay, going long means buying, and going short means selling. So, if you want to buy, this actually means that you are buying the base currency and waiting for the quote currency, because when you buy one currency, you sell another currency. It's a simultaneous action. So, if you open a buy position, you have bought the base currency. Okay, and now you're waiting for the quote currency to rise in value for you to sell it back. So you buy when it's low and you sell when it's high. That way the dividend in between gives you profit. Okay. Now, if you decide to go short, short means selling. You going short simply means you're selling. So selling means you are selling the base currency and buying the quote currency. It's a simultaneous action. If you have no open position, that is, you've not made any trade, then you are said to be flat, okay, or square. But square is mostly used like for closing a position. If you decide to close up a position that you have opened previously, then it's called squaring up. Now, let's go to the bid, ask, and spread. Now, the bid price is the price at which the broker is willing to buy from you. Okay, buy the currency from you. The ask price is the price at which the broker is willing to sell to you, sell the currency to you. Okay, and then the spread is simply the difference between the bid and the ask price that gives you the profit. Okay, now before we move forward, let me simply tell you what a broker is. A broker is like the platform or the company or the organization. Should I say organization? I don't know. Institute. Like, for example, if you're going to rent a house, you need to meet a broker, right? The broker is standing in between you and the landlord. So you are like the buyer, the broker is like the middleman, and then the landlord is the seller. So the broker is just between you and Forex. So they are the ones that bring the Forex market to you for you to trade through them, because you cannot go and trade directly in the market. Like, you're not that big. You need to have large lots, large sums of money to be able to trade directly. So you always have to trade via a broker. So those are they're the ones that will bring you the bid prices, the ask prices, and it's through them that you'll be making your shmoney. Okay, so each time you open up your trading platform, I use FBS trades. I use FBS trades because they are accurate, they are fast, and they are reliable. I open my positions and I close them very easily with no stress. Okay, this is an unbiased opinion. It's not being sponsored or anything. I'm just telling you what I used to trade. So when I started trading, I started with the FBS MetaTrader 4, and once I started getting better, I went from the FBS MetaTrader 4 to the FBS MetaTrader 5. So for a beginner, I'll recommend that you start with the FBS MetaTrader 4. Okay, the indicators there are really simple to use, and instructions are really simple to follow as well. So um, the beat and ask prices in general, this is how you see it. Okay, now this is the ask price. You see below here we have sell, so this is euro. So the broker is selling their euros at 1.34568. So for me, to make it easier for you, maybe me to understand how I usually look at it is, here when I see the ask price, I tell myself I am buying, because they are the ones selling. So it's not like you're going in. Here you're not going in for a sell. You are not the one selling, so the broker is the one selling to you, so you are the buyer. So here, to me now in my head is like, I'm buying euros for 1.3456, and then here the buyer sells the euros at this price. So this is an illustration of everything I've been saying so far about the base and the quote currencies. The quote currencies are also called counter currencies, so the same thing. Okay, the bid price, the ask price, the pips. Pips are just these numbers after the decimal point. So you use them to calculate how much you have made. Okay, and that's what you call the spread. The difference between this and this is called the spread. In Forex, we mostly count like from the fourth, 1, 2, 3, 4. Okay, the four figures after the decimal point are what are most important. Now, Forex trading is mostly done in lots. Okay, so lots are, you have different types of lots. You have the 1,000 unit lots, those are the micro lots. You have the 10,000 units, the mini lots, and then you have the 100,000 units, the standard lots. So it completely depends on your broker and what type of account you have to have more or fewer lots. Now, the margin trading. So margin trading is like the broker leverages your money. Okay, like maybe you put in 1,000 US dollars, and the broker gives you 10,000 US dollars to trade with. This simply depends on which lot you are using. Okay, for a micro lot, for example, let me not start with the mini lot. Let me go to the first one. For a micro lot, you will simply be trading in cents, because the profit you will make from micro lots will be calculated in cents. So if you make maybe 10 pips, this 10 pips is equals to 10 cents. So if you put maybe like $10, your broker will give you $1,000 to trade with, and whichever profit you make from there is calculated in cents. Now the mini lot, it's in dollars, but for example, if you have 10 pips, 10 pips will be equals to $1. Okay, $1. So if you put like maybe $100 in the mini lot, your broker will give you like 10,000 US dollars for you to trade with. Then for the standard lot, this is where you can get the most money because the lot is big and you can convert the money you put into huge sums. So they leverage you to trade, okay? And when this leverage is like, sorry, this leverage is like they're borrowing you money. Not really borrow, but it's just like they're adding the money for you to trade and make more profit. But if you turn to maybe blow your account simply means lose everything in the account. And once you have lost almost all of the money you put in, they are going to automatically stop the trade. They will automatically stop the trade. The broker has the right to automatically stop your trade if you no longer have funds, or maybe you've exceeded your deposited amount. So they will close your trade so they don't lose their money either. So the margin trading, like I just said, I don't have enough money to buy 10,000 euros and I can still trade. Yeah, you can. Your broker is going to leverage you with a ratio as per the transaction size. Okay, depending on what position you want to open, they're going to leverage. Most brokers can leverage you maybe 1:10, 1:20. But for me personally, avoid using high leverages because you would think you have a lot of money. Like you put 100 euros, for example, here you put 100 euros, and you think you have 10,000 euros, but you go and enter a trading position. Maybe you put in your, maybe you went in with like 50 of this 100 euros you initially deposited. Then you lose all of that, okay, because you're thinking you have 10,000. No, you don't have 10,000. You have just 100. They just leveraged you so you can make more profit. But aside that, you have just 100. Okay, so don't get it twisted. Just stay at the minimal leverage level and don't go too high. Okay, so the market order is simply the order to buy or sell at the best available price. So you always need to monitor your charts and be able to know when to maybe open a position or close a position. That's open, maybe buying or you're selling, and then close, maybe you're done. So you're either buying or selling again. So that is simply what the market order is all about. You can pause the video here to go through this so you understand what I'm saying. Okay, so this is a typical example of a Forex chart. So it's a chart is simply a visual representation of a currency pairs price over a set period of time. So this is basically how the Forex chart mostly look like. Okay. Now this is an uptrend. This is a downtrend. An uptrend means it's going up, so it's time to buy. Upwards like this. The blue line, most often you see the blue and red lines, or the green or red, blue or red. Blue green goes in for the buy, so this is a buy position. The uptrends, then the downtrends, mostly the sells, like for selling, sell positions. So this is uptrend, downtrend, side trend. With the side trend, it means there is buy and sell movements going up and down, just in between these two lines. So these are your sideways trends. So this is basically it, and then you have your prices here. These are the currency values here. So you'll be seeing which currency is going up, which currency is going down. And then here we have the lower lows and the higher highs. So with the lower lows and higher highs, it's easier to determine when to like open a position, go into the market. So as we move forward, I'm going to try to break down this chart as easy as for you to understand, but this is just how it looks, and this is a candlestick chart because there are different types of charts. So, and mostly, in fact, in Forex, almost 90% of traders mostly use the candlestick charts, the Japanese candlestick charts. It's so easy to read, and then in fact, the candlesticks can easily tell you when to get into the market and when to get out. Like the movements are very easy to read, and the formation of the candlesticks determine a lot. So candlestick, Japanese candlestick charts are mostly used to represent forex. I for one, I love them, so that's what I use. The first type of chart are the line charts. They look just like this, just lines going up and down, go up and down. So they're the line charts. Secondly, we have the bar charts. So it would just be this type of bars like this, moving up, 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 or down, 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 down. So it's just this type of bars. That's a bar chart. So this is a high. This is a close. Close means you close your position here. This is the oh, don't say candle now. This is not a candlestick. This is a bar. So at this point is the open position, and this point is the close position. So this is a bar type of chart. Then we have the candlesticks, Japanese candlesticks. Oh, I love them. They make life so easy for a trader, like this candlestick chart. So I will highly recommend for you to use candlesticks. So because they indicate high low ranges in vertical lines, they indicate high low ranges with the trends, either the uptrend or the downtrend. So like the indicators are awesome. I love the candlestick chart. It's very easy to read. This is how the candlesticks look like. This color, this black here, is mostly blue or green, and then this is mostly the red. Okay, so now this is the upper shadow and the lower shadow. Okay, this tiny lines are formed due to the pressure, the market pressure. So mostly when the let's say the selling pressure below here, because as you're going down is selling. So if sellers come in and just decide to sell currencies, you see the pressure here is going to like push up, and this is going to form like the lower shadow. But if buyers come in, because going upwards is buying. So if buyers just pour into the market and decide to buy maybe some particular currencies, or a particular currency, um, see the pressure here will be from upwards. So it's going to push it down, 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 forming the upper shadow. So it goes both ways. So this red candles, the candle body is red in color. It's for the selling, so the sell candles. Then if it's blue or green in color here, it's the buy candles. Okay. Now mostly for the selling candles, you open the positions below and you close at the top. Okay. And then for the buy candles, you open the position above and you close below. This is not same as the bar chart. Okay, remember for the bar chart, for all the types of trades, you open below and you close at the top. But for the candlesticks, you see the difference? It tells you that if you find me in a selling body, okay, if here I'm red and I'm telling you I'm selling, you have to open your position from below and close from the top. But if I tell you it's buying, and if I'm performing buying things here and my body is buying, I'm telling you to open the position from the top and close from below. So this is kind of stick chart. That's how it looks like. Okay. Here you can see this is the support and resistance levels. Okay. The resistance levels simply are the like when the graph moves upwards and stops at a particular point and then starts moving downwards. This is the formation of a downtrend here. So here you have a downtrend, which means it's time to sell. So this point here, the apex of this, is the resistance level. That means there was a resistance here from um, the sellers, okay, and then the price, the market fell, okay. But this trend from this end to this end, looking at this, it's an uptrend. So because it's moving upwards. But here is the resistance level. Now the support level is the price, is the level at which the graph, the, how can I say, the movement bounces back upwards. Okay, so once it starts moving upwards, it's giving you a buy position. So you get into buying when it's going upwards. So the resistance is the position at which the graphs or the movement tends to fall down, which is saying sell. And then the full, it's the level, the apex of the graph at which it starts moving upwards. The movement goes upwards, telling you to buy. But this is an uptrend. Okay, so if you are maybe a day trader, you would like to buy at this level because it will have little forms of resistance, but it's still moving upwards, which means it's telling you to buy. Okay, so that's just it. So here, when plotting support and resistance, you don't want the reflexes of the market. The reflexes are the little movements because you would love to go in maybe because the market, the time frames is divided maybe 15 minutes, there's 15 minutes, there's 30 minutes, 1 hour, 4 hours, 1 day, 1 month. So you will not go into maybe 15 minutes and then you take your resistance level from there or you take your support level from there. No, those are just little market reflexes or market noises. That's how it's called. So those are little movements that do not really make any difference. So you would like to go like maybe to a 4 hour chart or a 1 week chart, to get your resistance level or support level from there because these are long term um graphs movements. So you'll be able to actually deduce the movement or speculate the movement of the market from long-term uh, time frames. Okay, so I hope practice makes you perfect. The more you practice, the more you understand all of these trend lines. So this is an uptrend line. No matter how the graph is moving, as long as it's moving upwards, it's an uptrend line. This is a downtrend line. No matter how the graph is moving, as long as it's going downward, it's a downtrend line. Okay. Okay. So with Forex, there is also the take profit and stop loss positions. For example, when you open a trade, you should be able to maybe calculate where you will take your profit in case you're not there to monitor the chart all the time to be able to exit the trade. You can automatically designate your take profit value and designate your stop losses. Like if you're losing the trade, you can designate how much you want to lose. Okay, you put your value, stop loss value, and you just put it in your trade, and your broker will automatically execute those values when the movement of the market hits those values. Okay, so most often when trading, it's always good to put your stop loss like 10 pips below the actual entry price, and then you can take maybe your profits like 20, 30, at times 100 pips above your actual entry price. So, but just to avoid you losing a lot of money, I will always recommend you put your how do they say this, stop loss price. Oh, this is a long tutorial. Okay, I just hope this video is actually informative and helps you, because if it really does, then please just click on the subscribe button below and turn on the notification bell so you get notified anytime I post a new video. Please like and comment. Drop your comments below and tell me if this was really helpful, informative, and just let me know what you think. Okay? So, where was I? Your stop loss. Please always just accept to lose 10 pips in a trade, because losing more than 10 will make you feel discouraged, like maybe you're not doing it right. So it's always best to maybe just lose like 10 pips a trade. A lot, not too much, just 10 pips is okay. Okay, because
Why I say this is, while trading, you will notice there are a lot of movements. Okay, so if you put your stop loss at 10 pips, the market may fall, making you lose. Maybe it's going to get about 8 pips, and then it will bounce back upwards. Okay, making you get into profit. But if it had just closed at the 8 or maybe 7 pips, 6 pips, 5 pips, you will be losing money. You'll be losing money continuously. So it's always good to give that gap, because you don't know where the the market flow will bounce back. You don't know where, when, how. So it's just speculations. Okay. All right. So this website I use to give you a summary. I'm going to drop the link below in the description box. You can go to this website and then read profoundly and try to understand what Forex is all about. So what I've just done today is just give you a summary of Forex, so you have an idea of what you're getting into. This is not really a tutorial, but it's just an illustration, a summary demonstration, so you understand what Forex is all about. Okay, I really hope this video helps you, and hopefully I'll see you next time. Just drop your comments below. Let me know if you would like me to cover any other topics, but so far I've covered the most parts. And then let me just open my f my uh, my FBS, so you can see how it looks. It actually looks like. So each time you open, this is how it's going to look like. Okay, so your chart will always look like this. At times you can have four charts on the same screen for you to maybe like enter different positions with different currencies. So this is practically how the FBS account looks like. The MetaTrader 5. This is my MetaTrader account. So it basically looks like this. You can see my candlesticks here. Okay. This is a sideways. You see, I have my one line here and the other line here. So this already tells me this is a sideways trend. Okay. So I mostly love to trade when it's either uptrend or downtrended. These sideways trends are, to me, they are unsure. So to avoid losing money, I rather get into a position knowing that it's either going into the buy state or the sell state, downwards or upwards. So this is practically how it looks. And then almost all brokers, let me not say all, almost all of them will always give you what they call a demo account. A demo account is an account which you just open, and then the broker will put in funds. These are just fake funds, fake money, okay, to help you learn how to trade. So you will use the demo account to practice several times before you now get into actual trading with a real account. So please always try to use the demo accounts, okay? And then my best trading pair is the pounds against the US dollars. Why? Because I told you I was going to tell you why I trade major currency pairs. I trade major currency pairs because it's relatively easier to determine the trend. If it's going to go uptrend or downtrend or anything, it's relatively easy to determine with the major currency pairs. Okay, so to me, it's really, for me, my for me, how can I see this? Oh, girl, this is long. Okay, my opinion. In my opinion, it's really easy to determine the trend of the major currency pairs. So I always use major currency pairs. So it's either the pounds USD, pounds Japanese yen, pounds Canadian, not Canadian dollars, sorry, pounds, USD pounds, Canadian dollars too, but I rarely trade that. So I just mostly trade USD, pounds, JPY. So those are my three most traded currencies. So you can see here, this H4 stands for 4 hours. This is a 4 hour chart. So I mostly go into the 30 minutes, 15 minutes chart to be able to open positions. Okay, I use this now, the longer time frame charts, to determine the movement of the market, to determine the trends. Okay, so you can see here, this is my bid price, my ask price. I've just reduced my screen to make it really small, so that's why it's this tight. You can see everything. And then these are indicators. Indicators are simply these additional lines. They help you understand the movement of the market. Okay, they just help you. Like for example, this line is the RSI, the relative strength index indicator. So it moves like this. So it just tells me that at this point, like here right now, from this, I definitely see the market either moving upwards or having a breakout at this point. So we'll just wait for a few more hours and see if we can put in a trade. So this is just how it's going to look like from your PC. And you can also do this on your phone. Okay, I mostly use my PC to follow my trends, but I put in my trades. I open positions, close positions, everything with my phone because I cannot stay on the PC all the time. So I mostly use my phone to open and close positions directly just with my phone. So I really hope this video helps you. And if you have any questions for me, like I said before, just drop them below in the comments, okay? So sorry for taking so long of your time, and please subscribe. Subscribe so I know I'm doing something good. Please, if you don't subscribe, who will? If you don't like or comment on this video, who will? Okay, if you don't tell me if this video has helped you, how will I know? So please just help your girl right here, support your girl, and let me know if you're actually interested in trading Forex. Okay, if you have any questions for me, I'm all ears, or I'm all eyes, or I'm all fingers. Which one do they say safe? Type in now. I'm all fingers listening, waiting to reply. Anyways, thank you so much for watching, and see you on my next video.